On behalf of Tulane University's Burken Road Reports, this is the video presentation for continuing coverage on Superior Energy Services, completed by analysts Brandon Bunowski, Emily Ockerland, and Cody Walker. We forecast a 12-month target price of $33 and give Superior Energy a market outperform rating. We will begin with a brief company overview, including the company's financial performance and product segment breakdown. We will then give an industry outlook describing the opportunities and challenges Superior faces in the global oil and gas industry. We will then illustrate how we arrived at the target price of $33 and the market outperform rating, and will conclude with our investment thesis for the company. Founded in 1989 and based in Houston, Texas, Superior Energy Services initially was an oilfield products manufacturing firm. Today, Superior has grown to provide oilfield services and equipment to exploration and production companies throughout the world. As of 2013, the company had 14,000 employees with $4.5 billion in annual revenue. Superior Energy divides its products and services into four business segments. The drilling products, services, and segment currently represents 19% of the company's revenues and includes the designing, manufacturing, and selling of downhole drilling tools and surface rentals, such as temporary onshore and offshore accommodation modules. In 2012, Superior acquired Complete Production Services, making its onshore completion and workover service segment the company's largest sector, which now comprises 35% of revenue. The production services segment still accounts for a large portion of revenue at 32%, and the subsea and technical solutions segment makes up 14% of revenue. On a trailing 12-month basis, U.S. land operations through June 2014 generated 64% of Superior's revenue. The Complete acquisition in 2012 significantly increased the company's domestic onshore market presence. In 2014, rising horizontal oil rig count supported U.S. land growth, generating a 6% increase in revenue from the first quarter to the second quarter, and a 21% increase in drilling products and services revenue. For Gulf of Mexico operations, Superior's management stated that they are directly involved in a large percentage of deepwater rigs. In fact, 20% of the company's revenue was attributed to Gulf of Mexico operations. From 2012 to 2013, this segment saw 26% growth. 2014 Gulf revenue growth is not expected to reach 2013 levels. However, the company maintains a favorable outlook on Gulf performance due to increased demand for well completion services. Currently, Superior's international segment accounts for only 16% of revenue. However, it is the company's main focus for growth moving forward. We will discuss this further momentarily. In 1995, Superior initiated its public stock offering. In the last 5 years, the share price has seen a high of $41.49 and a low of $18.39. As you can see, in 2012, there was a major dip in the company's stock price due to the Complete acquisition. Again, in October 2014, the company saw a large decrease, mainly attributed to the negative outlook on energy stocks caused by commodity prices. In the last 3 years, Superior's cash and cash equivalents have been increasing exponentially, which allows for cash redeployments into any opportunity they find appropriate. Also, with the exception of 2012's Complete acquisition, capital expenditure has been around $600 million per year. As the company's cash continues to grow, Superior's ability to acquire or expand operations without the need for additional debt becomes more and more viable. The global oil and gas industry is one of the largest industries in the world, with 2014 revenues expected to reach $4.61 trillion. Superior operates within the upstream segment of the industry by providing exploration and production companies with equipment, rentals, and services throughout the economic life cycle of oil and gas wells. As such, the demand for Superior services is highly correlated with the spending habits of E&P companies. The major factors affecting capital spending of E&P companies are oil and gas prices, worldwide demand for increased energy, and technological advancements. E&P company output and oilfield service revenues historically mirror the movement of oil prices. As you can see from the graph, the price of crude oil has been increasing since 2009. However, it has begun to plateau and possibly decrease. the future increases are not expected to be as rapid as they were between 2009 and 2012. Technological advancements in horizontal drilling and hydraulic fracking have created new opportunities for oil and gas producers to capture value from unutilized oil reserves. The new technologies encourage expansion in production, leading to mergers and acquisitions among E&P firms. These acquisitions drive capital spending, which leads to increased oilfield services revenue. Because of Superior's market capitalization and diverse product offerings, it competes with much larger and smaller firms. Although Halliburton, Schlumberger, Baker Hughes, and Weatherford have much larger market capitalizations than Superior, each company offers similar products and services internationally, making them Superior's primary peers, in particular as Superior focuses on international expansion. Currently, however, Superior's largest market is the United States, making Basic Energy a strong comparable. Helix, Patterson, and Transocean's product lines are not as diversified as Superior's, but they are direct competitors in each of the business segments. Our team assigned a market outperform rating for Superior Energy and a 12-month target price of $33. The target price shows an increase of 42.5% from the close of business on November 4th, 2014, when the share price closed at $23.15. To arrive at this target price, we incorporated a weighted average of 5 methods, including discounted cash flow, price to earnings, price to cash flow per share, enterprise value to EBIT, and enterprise value to sales. Each of these methods accounted for 20% of our final target price. Our investment thesis includes 4 main points. The first being that as new technology develops, wells remain profitable for a longer duration, allowing Superior to provide personnel and equipment rentals to E&P companies for longer periods of time than in the past, producing increased revenues. With a large presence established in the Gulf, Superior will be able to rely on steady growth in existing customer operations to create free cash flow to deploy into other areas. Superior now focuses primarily on maintaining its strong position in the Gulf of Mexico and carefully reallocating assets to invest heavily in international expansion. International expansion is at the strategic forefront of Superior. As U.S. production begins to slow from its peak growth, Superior will target emerging but secure energy markets around the world to initiate or further develop operations. Superior's focus is on its core growth markets, particularly countries in Latin America, where the company already has established operations in order to mitigate the inherent risk associated with entering international emerging markets. Specifically, Brazil and Argentina have recently discovered huge potential for unexploited reserves. Lastly, shares continue to become more valuable as the dividend initiation provides an annualized yield of more than 1%. And the $400 million stock repurchase program continues to eliminate shares outstanding and increase the earnings per share. As Superior uses existing operations to generate large free cash flow, we expect well-placed acquisitions to occur internationally. If Superior is unable to find suitable strategic acquisitions, we expect a continued increase of share value by continuing the dividend and/or further share repurchase programs. Thank you for watching this Burkenroad Report on Superior Energy Services. The Burkenroad Reports are produced solely as a part of an educational program at Tulane University's A.B. Freeman School of Business. The reports are not investment advice, and you should not rely on them in making any investment decision. You should consult an investment professional and/or conduct your own primary research regarding any potential investment.